We are going to be talking about how the king dollar is coming to destroy the world. This is something that I have talked about quite a bit on this channel, in that the dollar itself is not something that is easily just evaporated away. Like, you're not going to just find nations out there easily getting themselves out of the dollar. Like, this whole de-dollarization movement is a very misunderstood idea on what it is that these nations out there who are trying to get out of the dollar, what they can actually do. Now, if you look down in the description of this video, I left a link to a bunch of different articles. One of them happens to be how Russia is boosting their U.S. Treasury purchases. Now, the general decline of Russia-held U.S. Treasuries is continuing. Like, they are getting out of U.S. Treasuries, but they cannot get out completely. Like, they cannot abandon the dollar in 100% fashion, considering how dominating the dollar is to world trade, to global trade. Even Russia, who would love to get out of it, who has been sanctioned, who is trying, or with the Western nations trying to prevent the Russian government from being able to transact in dollars, still finds themselves in a position in which that they need U.S. treasuries for the liquidity purposes of that particular asset. And this is something that is not going to change right away, simply because there is nothing else out there that can replace what it is that the U.S. treasuries are doing. Mainly because of the fact that there is so much of it. Like, the sheer amount of U.S. government debt available for purchase is matched by nothing else out there. Like, people say, well, they can get into gold, or they can get into Bitcoin, or they can get into another sovereign debt. There's not enough. Not enough considering what it is that the U.S. treasuries are doing. So when you think about the safe and liquid asset of the U.S. Treasury and how it dominates around the world when it comes to global trade, there is literally nothing else out there that can compete against it. And so even if you have the BRICS nations saying, hey, we want out of the dollar, we don't want the dollar, you're still finding that they are not only taking out debt in U.S. dollars, like we just recently reported on China doing $40 billion, I think is what it was, worth of dollar-denominated debt. This doesn't have anything to do with the United States. Not our banks, not our government, not our corporations, nothing. This is China selling bonds in U.S. dollars, and those bonds will be due in U.S. dollars. Again, we got Russia, who is buying U.S. Treasury debts. This is not the BRICS getting out of the dollar. This is the BRICS needing the dollar in order to continue to function. And I believe that's going to continue going into the future until something else can replace the dollar, which we already know from Gresham's law cannot be something that is in competition. It has to be in a symbiotic relationship to the dollar in order for it to be able to have the ability to then work side by side, so to speak, with the dollar, so that the dollar can be removed from existence, leaving only the new currency. Now, to understand how that would take place is to better understand that it's most likely going to end up being from a tokenized dollar or a central bank digital currency of some sort that trades one-to-one with the dollar. People will not recognize the difference between the two, whether they're using a central bank digital currency on a digital wallet or a debit card of some sort. They may not realize that they're not actually transacting in dollars because the two share the same business. And when that starts to take place, you can slowly move the dollars out, leaving only the new currency in. That's the way the dollar is going to end up being. That's how the dollar will fail. That's how the dollar will be removed from the system, is in that sense. Now, the dollar outright failing, like the dollars in our pockets no longer being able to make a purchase, that is due to a loss of confidence. But we're not seeing that happening. Like, if there was a loss of confidence within the dollar, then you wouldn't see China taking out dollar-denominated debt or issuing dollar-denominated debt. Same thing with Brazil and India and all the rest of the BRICS nations. Maybe not Russia, but Russia is participating in this dollar business by simply purchasing the U.S. treasuries. They are not getting out. Now, the other thing we have to look at here is the domestic situation that the Federal Reserve is trying to deal with, because not only are they're trying to provide enough dollars out there for the rest of the world to use, because there's this huge demand for their liabilities from the existence of things like Chinese dollar-denominated bonds. This is where the Federal Reserve finds themselves in a position in which it's like, man, there's a demand for our liabilities outside of the United States. That's one issue. The other issue is that we have this domestic economy to work with. Now, when people look at the Federal Reserve saying, they need to adjust rates this way or that way in order to make things accommodative or more restrictive because of the inflationary scenario, very, 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 very few people, and I mean, I say that so much out there with the very part of it, do not incorporate the neutral interest rate into their understanding of what it is that the Federal Reserve is attempting to do. And not understanding the neutral interest rate and how that impacts the Federal Reserve's monetary policy is going to leave you in a very compromised position, not understanding why it is that the Federal Reserve is doing some of the things that they're doing. See, even in the idea that the Fed is going to cut rates, people take on the idea, what is this going to do for real estate? What is this going to do for mortgage rates? What is this going to do for the housing market? And people take in this consideration that when the Fed cuts rates, it's going to have this major impact in a particular way going into the economy. Then they find out later on that those rate cuts really didn't have the impact in which that they had anticipated. Much like when the Fed cuts rates, you'll see mortgage rates come down. They didn't. They went up. In fact, they're still going up today. We're finding that the mortgage rates are not following the idea that when the Fed cuts rates, you will find interest rates being less going into the future. Now, that very well could take place, but it doesn't happen right away because there's a lag period from the time that the Fed takes action with the movement or the adjustment of the Fed funds rate or the interest rates in general. From the time that they make that decision to cut rates or raise rates, it can take anywhere from 6 months to a year before that actually starts to impact the economy. Now, people look at the Federal Reserve and they say, hey, they cut rates and mortgage rates went up. What is it that's going on with the Federal Reserve and what's going on with these mortgage rates? That is purely market perception. This comes down to what it is that the people are anticipating coming from the idea of these rate cuts and what it means for the economy. People look at the Federal Reserve saying, hey, they're cutting rates. That must mean that there's a bad economy coming into the future. And then they start taking action in that fashion. Very much different from what a lot of people were thinking. When the Fed cuts rates, that will make the mortgage rates cheaper. And we're going to find a lot of people going out there and buying houses. Didn't really happen. In fact, even now we're finding that the builders are backing away from new starts. This is something that we have reported on quite a bit here on this channel. Seeing as how I come from the building supply industry, I am seeing this firsthand, that there is not a lot of people out there demanding material for the new construction market. Is there new construction taking place? Absolutely there is. You're going to look out your window and say, no, man, look at all this new construction that is happening right here in front of me. You have to look at the bigger picture, look at the general economy across the entire nation, take a look at the links that I leave down in the description, and you're going to find that a lot of the things that I have been saying here on this channel are coming true, or that I got it right. You know, not everybody is going to get things 100% right all the time. And you have to understand that there is going to be changes to people's understandings as the information changes as well. Now, understanding that the Federal Reserve was in a position in which that the Fed funds rate no longer is the effective tool, and that their words, the jawboning, the forward guidance, the credible threat is the main policy tool coming from the Federal Reserve, we can see that a lot of the information that is being presented right now is having a major impact on the economy. And it isn't necessarily information that's coming directly from the Fed. Like, you have to think that the government is playing in this part too, with the credible threat theory. When they come out, when you hear so much mainstream media information talking about the tariffs and the impact of these tariffs on the economy and how it is that all these corporations and people and stuff are getting prepared for all these tariffs, nothing has happened yet. Not a single thing has happened yet, but yet people are acting and behaving in a way, getting prepared for something that has yet not occurred. That is a credible threat. Think about the things that I have talked about when it comes to the gold machine, right? The guy who invents a gold machine. And with that machine, he can produce as much gold at will with very little cost or energy. The moment that information gets out to the public, out there to the market, you would find gold plummet in price, right? Think about this. The information talking about tariffs, right? The moment this information gets out there to the public, the people start acting and behaving as if they had already happened. But nothing has happened yet. So this is very much a credible threat that's now impacting the economy in a very profound way as people are getting prepared for it. What ends up happening from this? When people are anticipating that there is tariffs coming, what do? They start acting in a way that creates an inflationary scenario, whether they're making bigger purchases or more purchases in order to acquire these items before the tariffs kick in or before the inflation comes from it. It actually creates an inflationary scenario just off of the expectations of it. Now you think about this, if you have an elevated inflation expectation, what's going to happen with interest rates? Right? If you are looking for a return on your capital investment and you believe that there's going to be an inflationary scenario, most likely you are going to demand a higher return on your capital investment. That is the raising of interest rates. So when you have a raising of interest rates and a belief of tariffs and a belief of inflation coming, what you end up doing is creating the inflationary scenario, which then begins to raise the neutral interest rate. Again, something that not a lot of people incorporate into their ideas of what it is that the Federal Reserve is up to. When you raise the neutral interest rate and the Federal Reserve is standing still, it makes the economy less restricted. See, when the Federal Reserve has the Fed funds rate far above neutral, that's a very restrictive economy. But if the neutral interest rate is rising off of the inflation expectation, what you will find is an economy that is less restricted, even if the Federal Reserve didn't cut rates. The restriction level starts to diminish, which actually creates somewhat of a stimulative aspect to the economy. It's not stimulating, right? But it is less restrictive, which then in turn puts people in this idea. It's like, hey, why is it that the economy is doing so well? Why is it that we're not finding the massive unemployment like we had anticipated when you see the layoffs happening? All the stuff that I had talked about from the past is now playing out. We have corporations who are failing, but because the corporations were able to gorge on incredibly cheap debt during the COVID pandemic, when the Federal Reserve was going through the quantitative easing with the special purpose vehicle of the corporate debt lending facility, putting the perception out there that the Federal Reserve was going to be buying into this corporate debt, the markets themselves jumped out there, started buying into this corporate debt, and literally funded the corporations with all the funding that they needed. So as the interest rates want to go rise and everybody was saying, man, these corporations are going to fail, the zombie corporations are failing. Those who cannot operate without taking on ever increasing amounts of debt are failing. Those who are sitting on cash positions are able to weather the storm. Again, this is something that we had talked about on this channel, and it's probably lending to the reasons why you're seeing a lot of layoffs, but not seeing the unemployment rising in a significant fashion. It's because those who are getting laid off are going to work at the service industry. It's not a good job, but it's a job. And if you're working a job, you're able to generally pay your bills. You may not be paying all of them. You may be going into debt. You may be having issues with it. But if you have a job and you are able to continue to make your payment, then most likely you're not going into foreclosure. And even if you were in a position in which that you were going into foreclosure or that you weren't able to make your payments, you just sell your house. It's not like all these houses are sitting underwater. Like there are a lot that have been purchased in the last year or 2 years that may be sitting, close to the idea that they are underwater on it. But when the majority of the houses and mortgages out there are far above water, they could just simply sell their house off and not have to go into foreclosure. So where is this rise of massive recession pressure that a lot of people were anticipating? We're going through a recessionless recession, something that I had communicated and talked about and done videos many years ago, like 2-3 years ago I was talking about this. So we're seeing it playing out now. And although we have this idea that the dollar is going to disappear from all the money printing, and it's obvious when the Federal Reserve prints money that you're having destruction of purchasing power, what very few people take into consideration is that there's very little else out there to compete against what the dollar is doing. And when the Federal Reserve is in a position in which that they have to provide the liabilities, which is the cash, the Federal Reserve notes, the Federal Reserve's liabilities is in high demand outside of the United States. Generally, people just look at all the money printer and say, hey, look at what this is doing to our domestic economy. Very few take in the idea that there is a huge global economy out there that has written debts that are due in dollars. And when those debts come due, King Dollar Destroyer comes to annihilate these nations, these corporations. you're going to find that China is actually going to be a beneficiary of a king dollar destroyer type of environment, as they have issued out debts to nations out there with the Belt and Road Initiative, lending them money so they can build up their infrastructure. They did it in dollars, US dollars. This is, again, China, sovereign nation, working with another sovereign nation, lending them money so that they could build up their infrastructure, and they do it in US dollars. When the dollar rises and that nation can no longer pay its debt, those infrastructure projects become that property of China. And this is something that is happening today. This is an issue that the IMF is trying to deal with, like to try and keep these nations from going bankrupt or defaulting on those debts to China so that China doesn't take possession of it all. This is huge. Dollar funding stresses in China is a serious deal. And how much that can actually impact the global economy when you consider that China is the major manufacturer of the world's products out there. When you start finding situations in which that China has risen their standard of living and their manufacturing base is no longer competitive against the cheaper manufacturers out there in the world, you're finding that those manufacturers are leaving China to go to cheaper operations. China doesn't have the ability to bring in new money like the United States did when their manufacturing base was leaving. See, we were bringing in new money from all the manufacturing that we were doing, building the world's greatest products. We send out those products, those people sent us their gold. Well, eventually we acquired all the gold. They were going to go into a position in which that depressionary forces were going to start ripping around the world if we didn't relinquish that gold back out there in a redistribution of wealth. We decided, nah, we're going to keep that gold and we'll redistribute out U.S. treasuries in place of gold. Wouldn't that be nice for y'all? And now this is a situation in which that China cannot duplicate. They were a great manufacturer of the world's stuff, putting it out there for everybody to buy. They raised their standard of living, and now when it's coming time to bring in new money, manufacturing isn't going to do it. They cannot be the issuer of debt like the U.S. Treasury, because nobody is going to trust China on that level. China is going to get very upset, and they are going to do something. And most likely, it's probably going to be quite violent, as they have really no other choice but to take over other nations in order to get that new money in. I mean, this is serious stuff that we talk about here, and many people don't take it into consideration. They look at the dollar, they look at the Fed, they look at our government, they say there's too much debt, too much printing, it's all going to fail, and we don't have to stress about what it is that happens if the dollar continues to operate. See, most people don't take in that consideration. They think that the dollar is going to fail. They're going to fail next year. Like, how many people were of the mind that there was going to be hyperinflation scenario taking over right now? What do we have? Inflation moderately above 2%. Now, I'm not sure exactly what moderately above 2% is supposed to mean, but I know that was part of the Federal Reserve's monetary policy, one that they had talked about back in August 27th of 2020. In a Jerome Powell speech, saying that this is the situation we are going into, in which that they are going to allow inflation to run above the 2% target. Many people don't understand that. They don't see it. They don't even know why. Why would they even do that? Not realizing that quantitative easing 1, 2, 3, and 4 failed to produce the inflationary scenario that the Federal Reserve was looking for. So by 2018-19, they knew that they were in trouble. That zero interest rate policy was not enough to create an inflationary scenario for the Federal Reserve's monetary policy to operate. They were stuck. And without the pandemic and the ability to go into massive quantitative easing again in order to create the inflationary scenario that was so desperately needed by the Federal Reserve in order to conduct themselves, who knows where we would be right now? The pandemic literally saved the Fed. Yeah. So strange to think. Okay, I got like 5 minutes left here. Let's read a few questions and we got to call it quits. I only got about literally 5 minutes left here. Okay, let me cruise it up here a little ways. We got All Nighter saying, welcome, Andrea. You made it. Thank you, Andrea B, for being here. All right, U.S. of A just passed 36 trillion in debt. Be an owner, love the worker. Why is the Fed forced to disclose their plans, i.e. briefings? I believe they shouldn't, especially because it's free market capitalism. They release their idea of what it is that's coming. See, there was a time when they didn't do that. They were very secretive. They kept it all very quiet, and they didn't want anybody to really know what they were up to. In fact, they said that monetary policy would function better if it surprised the markets. Like you would just wake up one day and you looked and the Federal Reserve had adjusted rates and nobody knew that they were going to do this. Well, they found out over time that if they communicate about what it is that they are going to do, they can get more out of those interest rate adjustments. And in fact, they found out that if they communicate well in advance and very clearly and communicated in very different, like in a bunch of different channels to very different types of people, that they could get this information out in a very efficient way to then have their interest rate adjustments be the most powerful ever. So they found that communicating about it was more important than the actual adjustment of rates. So right now, the Federal Reserve has developed ways of not only communicating their future thoughts through things like the dot plot, but the releasing of the minutes, the press conferences, all this like president interviews and governor interviews and stuff like that. All of this is all part of the Federal Reserve's monetary policy when it comes to the credible threat theory. Like most people don't understand the credible threat theory at all. They just look at the Federal Reserve and the adjustment of interest rates as their main policy tool. That is not it. I tried to explain this so many times to people over and over again. The information talking about those rate cuts is the monetary policy coming from the Fed. You know that the rate cuts aren't it. Because if the rate cuts were it, then we would have seen like mortgage rates come down, right? Like that would have gone in relation to the Federal Reserve and their adjustment of rates. But we didn't see that happen. It's the communication about what's coming in the future that has more of an impact on the economy than the actual rate adjustments do. When the Fed hit the lower bound of zero, they knew it then. That was it. It was over. Adjustment of interest rates for monetary policy is no longer the effective tool. It's been that way since 2008. Right? But nobody knows that. So they communicate about the interest rate cuts or the interest rate adjustments in general, whether it's up or down or sideways, whatever. They communicate about that, and then that communication has the impact on the economy. And that is the monetary policy tool. And so understanding it in that fashion then gives you much clearer and a much broader understanding of why it is that the economy operates the way it does. Because you're taking the information about the rate cuts and putting that into market perception of what it is that can occur within the economy. Instead of thinking Fed cuts rates, mortgage rates come down, right? Or money printer go up, prices go up. Right? You take these two scenarios out and then you can start understanding it in a much different fashion. You can understand the supply-demand imbalances that was creating the inflationary scenario that we had seen, that we'd experienced. See, most people just say, hey, money printer go off, prices go up. Cannot. Those people cannot explain how the expansion of the balance sheet from $850 billion to over $4.5 trillion failed to produce the inflationary scenario that the Fed was looking for. So money printer go burr, prices go up did not occur during the great financial crisis and the quantitative easings of 1, 2, 3, and 4. So you can't use that the excuse. Anybody who does, I'm sorry, you're being naive, right? Yes, money printing does create a situation in which that we can have an inflationary scenario. But if that money sits in the bank, it doesn't chase the goods and services. And that's the experience that we had during quantitative easing 1, 2, 3, and 4, is that it expanded the big bank's balance sheet, but unless that money was lent into the system, it didn't chase the goods and services to create the inflationary scenario that the Fed would be looking for. When you inject money into all channels, all of a sudden everybody had money in their pockets, stimulus checks, enhanced, unemployment, whatever. They all of a sudden ended up with a bunch of money in their pocket, and then the supply chain got severed, and all of a sudden people are out there buying stuff, but the replenishment of that stuff doesn't occur. You have supply-demand imbalances. You are definitely going to have prices increase. But now when you think about the Federal Reserve and the quantitative tightening that they have done over the last few months and years, what is it going on over a year? The quantitative tightening, which takes the money out of the system, which has been going on for quite some time, has not reduced the inflationary scenario in which that people would have anticipated it doing in a profound manner. We didn't really even pull that much money out. Like, the monetary base is not the condition in which that you look to see if inflation is moving up or down. Now, that's what everybody wants to, because it's simple, right? The amount of money, prices go up, right? These two are hand in hand. What a lot of people do not take into consideration is that the money printer go off, consumption increases. And if that money isn't lent into consumption, then it doesn't create the inflationary scenario. See, we are expecting the inflationary scenario from all the money printing, but what a lot of people don't take into consideration is that that money was spent on beer, right? If you had two products to buy, either a production like saws, where you can cut up lumber and produce something that you can sell, or all that money goes into production of beer, which is a consumable item that once it's gone, you now have to work with a hangover to pay it off. We invested into beer. So yeah, you saw a lot of stimulus take off. You saw the inflation take off. You saw all the hot economy taking off. But what people don't seem to realize right now is that we are going to be working with an incredibly bad hangover in order to pay for all that consumption. And this is the situation that we are going to go into for a lot of people, especially the working class individuals who are going to be suffering the most from this. The people on the other side of the wedge, oh, well, their capital investment might be a little deteriorated, but they're going to be on the other side of the wedge, and they're not going to have a situation that they are going to be facing like those who are at the bottom side, where all of a sudden a loss of income means that they're going into bankruptcies, foreclosures, all the issues that come from people who live paycheck to paycheck. It's going to be a major deal going into the future. Even a good job sucks. I want to keep going off, guys, but I got to go back to work. Thank you so much for being here. We got 234 people watching with 63 likes. Go continue to hit that like button. Come back here for the upload, and we'll continue on with this conversation. Uneducated Economist. You guys let me know.